All right, everyone, let's get started. Today, we are going to dive into a concept that is, and I'm not exaggerating, the absolute foundation of the entire Canadian GST/HST system. It's the characterization of supplies. Seriously, if you don't get this part right, the rest of it just won't click. So let's jump right in. And just a quick note, I've put this explainer together as a key study resource for our course, so please make sure you use it when you're prepping for your exams. It'll really help. So, here's our game plan for today. We're going to start with a quick introduction to GST/HST, just to get everyone on the same page. Then, we'll get into the real meat of the topic, the 3 types of supplies. We'll break down each one, and then, at the end, we'll pull it all together by comparing them and seeing how this stuff actually plays out in tax reporting. Okay, let's kick things off with Section 1. Look, before we can start categorizing supplies, we need to have a really solid grip on the basics. So let's do a quick refresher on what the goods and services tax actually is and, how it works. So, what is the GST? Well, at its heart, it's a tax on consumption. But here's the single most important thing to get straight. Businesses don't really pay this tax. They act more like collection agents for the government, for the CRA. Their job is to collect that tax from you, the customer, and then pass it along. And that leads us to a really fundamental principle of this whole system. Even though businesses are the ones handling the money and filing the returns, the real economic weight, the actual cost of the tax, is designed to land on the final consumer. That's the person at the very end of the supply chain who is actually using the product or service. Now, this brings us to the magic ingredient, the engine that makes this whole thing run smoothly, the input tax credit, or ITC. Just think about it for a second. If a manufacturer paid GST, then a wholesaler paid GST on top of that, and then a retailer, well, the tax would just stack up. It would cascade. The ITC is what stops that from happening. It's this brilliant little mechanism that lets a business get a full refund for any GST it paid on its own business expenses. Now, as you probably know, Canada doesn't have one single sales tax rate. It's more of a patchwork quilt. This table lays it out pretty clearly. You can see provinces like BC have the 5% federal GST, and then they tack on their own separate provincial sales tax, or PST. But then you look at a place like Ontario or the Atlantic provinces, they've actually blended their provincial tax with the federal one to create one single tax, the Harmonized Sales Tax, or HST. And believe me, that's a huge difference in practice. Okay, so now that we've got that foundation laid, we can get to the real heart of today's lecture. Section 2, the 3 types of supplies. Every single transaction for goods or services in Canada, everything from buying a cup of coffee to selling an office tower, has to fit into one of these 3 boxes. And here they are: taxable, zero-rated, and exempt. Getting the right category is, well, it's everything. It determines whether you charge tax to your customer and whether you can get your own tax money back. As a future tax professional, this is always one of the very first questions you're going to ask. So let's break them down. All right, first up, let's look at taxable and zero-rated supplies. Now, we're lumping these 2 together for a very, very specific reason. They are both considered to be fully inside the GST/HST system, and you'll see exactly what I mean by that in just a moment. I want you to think of taxable as the default setting, the catch-all category. If the law doesn't specifically say something is zero-rated or exempt, well, then it's taxable. This covers almost everything you can think of: cars, clothes, hotel stays, and yes, even the legal and accounting services you'll be providing someday. The rule here is super simple. You charge your customer GST/HST, and you get to claim ITCs on all your business costs. Now, this brings us to their very interesting cousin, zero-rated supplies. And here we have a paradox that you absolutely have to wrap your head around. Zero-rated supplies are taxable supplies. Let me say that again, because it's important. They are taxable. The only difference is that the tax rate has been set by law at 0%. Now, I know it sounds like a totally bizarre distinction, but the logic behind it is the absolute key to this whole system. And here are your classic examples. You'll probably notice a theme right away. These are often things we consider necessities, right? Basic groceries, prescription drugs, certain medical devices. The government wants to give consumers a tax break on these items, but, and this is the whole point, it wants to keep the businesses that provide these supplies fully inside the GST system. So this leads us to a really great question, one that kind of pulls back the curtain on some of the weird and wonderful details of our tax code. Is it possible for the exact same product to be treated differently depending on, say, how you sell it? The answer is a resounding yes. And my all-time favorite example of this is what I like to call the donut rule. If you go buy just one donut, The law sees that as a ready-to-eat snack. It's a taxable supply, so you pay GST. But if you buy a pack of 6 or more donuts, all of a sudden, the law changes its mind. It reclassifies them as basic groceries, and the sale becomes zero-rated. Same donut, totally different tax result. It just goes to show how specific and detailed these rules can be. All right, let's switch gears and move to our final category. This one operates on a completely different logic. This is Section 4, exempt supplies. If taxable and zero-rated supplies are inside the system, then these guys are completely outside of it. And here is the definition you need to burn into your memory. For an exempt supply, the provider does not charge GST/HST. But, and this is the part that changes everything, they also cannot claim any input tax credits for the GST they paid on any expenses related to making that supply. So what are some common examples? Things like long-term residential rent, most health and financial services, and yes, your university tuition. The details here are so important. For instance, the sale of a brand new house is taxable, but a used house, that's exempt. A weekend stay at an Airbnb is taxable, but your monthly apartment rent is exempt. These little distinctions are where tax professionals earn their keep. Okay, let's bring it all home. In this final section, we're going to put all three categories side by side and see how this whole thing, which might seem a bit academic, has very real consequences for how a business actually files its taxes. So, here it is, the crucial point. If you remember nothing else from today's lecture, remember this slide. It's the difference between zero-rated and exempt. In both cases, the customer pays no GST. That feels the same to them, but for the business, the provider of a zero-rated supply can claim ITCs, while the provider of an exempt supply cannot. This is the single most important distinction to understand. This table right here is your study guide. It's your cheat sheet. Print it, memorize it. It all boils down to two simple questions. 1, do you charge GST? And 2, can you claim ITCs? For taxable supplies, yes and yes. For zero-rated, yes, but at 0%, and a big yes to ITCs. And for exempt, no and no. It's that clean and simple. So why on earth does this matter in the real world? Here's a perfect example. A business's mandatory filing frequency is based on its total annual taxable supplies. And remember what we said? Taxable supplies include zero-rated supplies. So let's imagine a huge corporate farm that has, say, $10 million in revenue. Even though they only sell zero-rated grain and never charge a single penny of GST to their customers, they are still considered a large supplier. That means they have to file a GST return every single month just to claim their ITC refunds. So let's wrap this all up with the one key takeaway. The ability to claim input tax credits, that's the bright line that divides the entire GST/HST world. If you can claim ITCs, you're in the system. If you can't, you are out. It really is that simple. And I'll leave you with a final thought, a little puzzle to chew on for next time. We say that exempt supplies, like a visit to your dentist, have no tax. But think about it. If that dentist has to pay GST on her office rent, on all her expensive equipment, on her supplies, and she cannot claim any of that back as an ITC, where does that tax cost actually go? Does it just disappear into thin air? Or does it get quietly embedded in the price she charges you? We'll pick that up next class.